They want you fixated on gold. They want you dazzled by the record-breaking numbers on tonight's financial news. It is a perfect magic trick. But while the crowd is busy chasing the glitter of gold, down in the vaults of the London and New York exchanges, a real bleed is taking place. Silver isn't just rising in price, it is physically vanishing from the system. This isn't about numbers on paper. The world is running out of the one metal that powers the green economy in the modern war machine. Today, I won't give you empty hype. I'm going to open the macro data files and analyze supply and demand to prove to you why we are facing the decade's largest structural imbalance. Welcome to the Strategy Report. Let's get into the data. To understand why silver is the most important story right now, we need to ignore the short-term noise and look at the big picture. Against a backdrop of escalating geopolitical tensions and global monetary policy uncertainty, the precious metals complex has recorded superior growth. However, there is a distinct divergence. While gold is successively setting new all-time highs due to frantic buying from central banks, silver is quietly forming a much more strategic price setup. My thesis today is clear. Silver is currently irrationally undervalued relative to its fundamentals. Let's start with the first macro factor, the safe haven role. Tensions in the Middle East and Eastern Europe are no longer isolated news events. They have become persistent risks. In this environment, smart money always seeks out hard assets. Although gold is the top choice for sovereigns, silver plays the role of a high beta safe haven. History proves that when gold rises 1%, silver tends to rise 1.5 to 2%. The second macro factor is monetary policy. The market is pricing in the probability that the Federal Reserve will be forced to ease to support the economy. When the tightening cycle ends and the dollar shows signs of weakness, that is the strongest tailwind for silver prices. But that is just the tip of the iceberg. The real story lies in the next section, supply and demand. Unlike gold, where most supply is stored in vaults and recirculated into the market, silver is an industrial metal that is consumed and extinguished. This is the key point that Wall Street often ignores. On the demand side, we are witnessing a shock from the energy transition. Silver demand no longer depends on jewelry or photography like in the last century. The current driver comes from the green economy. The solar industry is booming with next-generation battery technologies like TOPCon and HJT, which require a much higher silver content to achieve optimal conductivity. Add to that electric vehicles and artificial intelligence. You cannot run an AI data center or a guided missile system without high-quality semiconductor components, where silver is an irreplaceable material. But on the other side of the scale, supply is facing serious challenges. Here is a fact few people know. About 80% of global silver supply is merely a byproduct of copper, lead, zinc, and gold. What does this mean? It means silver supply is extremely inelastic. Mining companies cannot simply increase silver production when the silver price rises. They only dig up more silver when the demand for copper or zinc increases. Furthermore, we must address the CapEx crisis, capital expenditure, in the mining sector. For the past decade, under pressure from ESG mandates and low commodity prices, mining companies have drastically underinvested in exploration and development. They have prioritized stock buybacks over digging new holes. Here is the harsh reality. It takes, on average, 10 to 15 years to take a mine from discovery to production. Even if the price of silver doubles tomorrow, new supply cannot come online until the mid-2030s. We are facing a supply cliff that no amount of money can bridge in the short term. The geological reality is colliding with the industrial necessity. Data from the Silver Institute shows the market has experienced a supply-demand deficit for 4 consecutive years. This deficit is gradually eroding the visible stockpiles at Comex in London. We are draining the final bars out of the vaults. So where is the opportunity? A professional investor doesn't look at price, they look at relative value and market structure anomalies. The East-West arbitrage. There is a critical anomaly occurring right now that demands your attention: the Shanghai Premium. While Western markets trade paper silver, futures contracts, to set the price, Eastern markets, specifically the Shanghai Gold Exchange, are trading for physical possession. We are seeing silver trade in Shanghai at a premium of 10% or more over the Comex price in New York. This arbitrage window is a flashing red signal. It tells us that while Western hedge funds are shorting paper contracts, Eastern buyers are draining physical inventory. The smart money in the East is willing to pay significantly more to secure the metal now. This flow of metal from west to east is tightening the physical float to a breaking point. When the Comex vault runs dry, the paper price will have no choice but to gap up to meet the physical reality. Now, let's look at the gold-silver ratio. Currently, this ratio is hovering around 85. That means it takes 85 ounces of silver to exchange for 1 ounce of gold. Let me give you some context. The average in the 20th century was only about 47. This indicates that silver is absurdly cheap compared to gold. According to the law of mean reversion, if the precious metals market continues its uptrend, silver has an upside potential many times greater than gold to narrow this gap. Regarding market sentiment, the Commitment of Traders report shows that large funds are holding net long positions, but they have not reached extreme levels. This is very positive. It means the market still has plenty of room for new money to enter without fear of being overbought. However, as responsible investors, we must look at both sides of the coin. What are the risks? The biggest risk is a full-blown economic recession. Since over 50% of silver demand comes from industry, if factories close and manufacturing demand drops, silver prices will face pressure in the short term, unlike gold, which is a pure defensive asset. Additionally, if the Fed maintains higher for longer interest rates to fight inflation, the strength of the dollar will be a headwind hindering price appreciation. To summarize, based on the convergence of macro and micro factors, my strategic view on silver is bullish in the medium to long term. We are standing before a perfect storm. Monetary demand is supported by geopolitical instability. Physical demand is driven by the irreversible green industrial revolution. Meanwhile, supply is constricted by a decade of underinvestment and cannot react quickly. We are witnessing a gradual decoupling between paper silver prices and physical reality, evidenced by the widening Shanghai Premium. As stockpiles continue to drop to alarmingly low levels, the pricing mechanism will be forced to reflect the true scarcity of this metal. My advice? Watch the inventory data and the arbitrage spreads closely. Do not let short-term price fluctuations deceive you. When the monetary system shakes, gold is the shield, but silver is the sword. Thank you for watching this report. See you in the next analysis. There has been an unwritten rule on Wall Street for the past 40 years. Silence on a Friday evening usually signifies settlement. Positions have been closed, risks have been hedged, and the bankers have left their offices to enjoy the weekend. But this weekend, that silence carries a completely different tone. It is the calm before a Category 5 storm. Last Friday, we witnessed a technical black swan event. According to the standard script, silver prices are always subjected to automated selling pressure during the final session of the week to crush the momentum of the bulls. But this time, that script was torn to shreds. Instead of collapsing, the market accelerated and closed at the absolute highs of the week, $67.14. Let that number sink into your trading psychology, $67.14. For the retail investor, this is good news, but for the risk management departments at the major bullion banks, this is a liquidity disaster. They are currently trapped with billions of dollars in net short positions that are deeply underwater while the market is closed. They are locked in a panic room with no exit for 48 hours. In today's deep dive report, we are going to dissect this event. We will analyze why this closing price is not just a number, but the fuse that will trigger a massive chain of margin calls come Monday morning. To understand the severity of this, we need to look at the market microstructure. When a market closes at the highs of the week, it sends an incredibly powerful signal. The buyers accepted market orders at any price, right down to the final seconds. This indicates that smart money currently fears the risk of not owning the asset more than they fear the price risk itself. Put yourself in the shoes of a market maker who is short silver in the $64 region. Their quantitative models predicted a drop to $60 so they could cover and take profit. But reality forced the price to $67.14. Their unrealized loss is currently sitting at over $3 per ounce on a volume of millions of ounces. But we must also address the elephant in the room, the options market and gamma exposure. At $67.14, we have pushed deep in the money, ITM, for a vast array of call options that were previously written off as worthless. This forces options dealers into a gamma squeeze. As the price rises, dealers, who must remain market neutral, are mathematically forced to buy more of the underlying futures to hedge their exposure. It becomes a feedback loop from hell for the shorts. They aren't just fighting the trend, they are fighting the mathematics of the derivatives market itself. Furthermore, we must anticipate the reaction of high-frequency trading algorithms. These black boxes thrive on momentum ignition. A gap opening above $67.14 will trigger automated buy programs before a single human trader has had their morning coffee. These algorithms do not care about valuation, they only care about velocity. They will pour fuel on the fire, exacerbating the move in milliseconds. And here is the fatal issue: variation margin. Typically, these losses are settled in cash at the end of the day, but Friday's price shock was too massive and too fast. It blew through the credit lines of many hedge funds. On Saturday morning, while the market was closed, margin calls were sent out. The demand is simple: post additional collateral before the Asian Open on Monday or face forced liquidation. And when a short fund faces forced liquidation, the computer system executes only one command: buy back at any price to close the position. This creates a classic short squeeze scenario. On Monday morning, we may not see buying power from natural demand, but buying power born from the panic of financial institutions trampling over each other to exit. However, the financial story is just the tip of the iceberg. The submerged part, and the most dangerous part, lies in the dislocation between the paper market and the physical market. We are witnessing a record-breaking arbitrage spread. In New York, Comex, silver is at $67.14, but in Shanghai, SGE, silver is trading around the $72 mark. A $5 spread in the commodities market is a massive figure. It creates a vacuum effect. Any silver bar that can be moved is being packed and shipped from London and New York to China. The West is suffering a physical liquidity drain. Why? Because industrial giants like Samsung or Tesla cannot operate production lines using futures contracts. They need real metal. They are executing off-market deals, securing supply directly from the mines, bypassing the Comex entirely. Furthermore, we are hearing reports of a quiet run on the bank regarding unallocated accounts. For years, banks have sold paper claims on silver they do not fully possess, a fractional reserve system. But now, high-net-worth clients and family offices are demanding conversion to allocated status. They are asking for the serial numbers. They want the bars moved to a segregated shelf. This forces the banks to show their hand. If they don't have the metal, they must go into the open market and buy it immediately to satisfy the client and prevent a default event. This internal squeeze is invisible to the public, but it is the primary driver of the desperation we are seeing. The consequence? The spot price on your screen is slowly becoming a virtual reference. It no longer reflects the true cost to possess the physical metal. Registered inventory, metal that meets delivery standards, is depleting at an alarming rate. We are approaching 0 hour. When the Asian markets open, the most probable scenario is a gap up. The price could open directly at $68.50 or $69, skipping the intermediate levels entirely. However, as professional investors, we must keep a cool head. Extreme volatility always comes with risk. Here is the battle plan for the upcoming session. Patience in the face of a gap up. If the market opens with a massive gap to the upside, do not FOMO. In theory, the price often tends to return to fill the gap, to test demand. Watch the support zone at $67. Beware the shakeout. Understand that the institutions know the retail psychology. They may engineer a sharp, violent drop, a rug pull in the early hours to trigger stop losses and flush out weak hands. Do not mistake a liquidity flush for a trend reversal. Monitor the psychological level of $70. This is not just a round number, it is the last bastion of the bears. If the price decisively breaks $70, the technical model shifts to a parabolic state, vertical appreciation into the price discovery zone. Focus on real assets. In an environment of elevated counterparty risk, holding physical positions is the optimal defensive measure. In conclusion, Friday's closing price of $67.14 is not the destination. It is the siren signaling the collapse of the old price control algorithms. The bank's liquidity nightmare is becoming a historic opportunity for investors who are prepared. I will continue to update you on capital flow developments as soon as the session begins. Thank you for watching.